Bank of America surging 2% today, but underperforming its money center peers over the last 3 months. The stock is down 22%, while Wells Fargo's down 19%, Citi is down 11%, and JP Morgan down 6%. So why have investors been turning their backs on BAC? Let's bring in Gerard Cassidy, Managing Director and Head of U.S. Bank Equity Strategy at RBC Capital Markets. Gerard, great to have you with us. You say the answer lies in the difference between its bond portfolio and its peers' bond portfolio.
Yes, Melissa, when you take a look at the underperformance of Bank of America relative to its peers, I think the big hang-up that investors have had is that they have a very large bond portfolio, and it has about the held-to-maturity portion of that portfolio has an average duration or average maturity, I should say, of about 8 years. And so that's weighing on the growth, the net interest income, since that portfolio is at lower rates than what you can get today.
So does that material, versus the competitors, Gerard, are your expectations for Bank of America in terms of profitability, are they much different because of this difference in its bond portfolio?
I wouldn't say it's much different, Melissa, but in view of what's going on in the banking sector with what we saw earlier in the year with the failures and the big issue of the unrealized losses in bond portfolios, becoming a concern for investors. Bank of America has those issues as well, the unrealized losses, but they'll manage through that. The portfolio will burn down over the years to come, and they have plenty of core deposits. So we're not worried about that, but it's just that it may weigh on their profitability again on the net interest income line. And I think people have moved to the sidelines because of that.
Hey, it's Courtney here. Thanks again for having us. I completely understand your point here and why they're underperforming. And I'm curious, too, how much of this is you're starting to see consumers who are nervous about banks are heading to something like a JP Morgan, which is kind of tried and tested in a recessionary environment, considered a little bit more of a safety play. And so I'm wondering how much of that plays into the underperformance and how much of that is already priced in. And should investors be looking at this as more of a buying opportunity, considering how much is underperformed this year?
Courtney, I'm with you on the last point that it is definitely a buying opportunity because it has underperformed. And as Bank of America showed in the first quarter results, they saw an influx of deposits like JP Morgan. So nobody's avoiding Bank of America or JP Morgan for that matter. And the entire deposit flight problem, as we move away from those failures of March, I think that's going to die down further as we go forward. And the banks will start to regain some momentum as people understand that those banks that failed were really idiosyncratic problems, and it's not reflective of the industry at all.
Do the banks regain momentum, Gerard, simply because it'll look like a bad situation that gets a little bit better, or they're real fundamental? If you think about what is ahead, we've got a debt ceiling debate which could drive bond yields higher, which would make it worse for the entire sector in general. We've got potential consumer under stress. We've got tightening credit. We've got banks that have to pay out much higher interest rates in order to maintain that deposit flight. I feel like there was a reason why banks stuck to 0.1% on a savings deposit for as long as they could until they had to raise it to market rates.
No, you bring up some very valid points, Melissa, and I would point out that the way that deposit betas are working, which you just referenced, raising those deposit rates, is very similar to past tightening cycles. And what's fascinating to us is in the last 4 tightening cycles, once the Fed reaches the terminal rate in Fed funds rates, then you start to see the banks behave better because what's likely to happen is deposit rates stop going up 1 to 2 quarters after the terminal rate is reached, but the banks are still reinvesting cash flows from the securities portfolio at higher yields, and the margins start to stabilize. And that we could see that by the end of the year. But you're right, there is a lot of cross currents out there in the economy, and that is certainly affecting the bank stocks. But if we really have seen the last of the Fed fund rate increases, that's going to be, I think, a real positive catalyst for the banks on the next 6 to 12 months.
Hi, Gerard. Bonawyn here. So if you listen to a lot of these investor calls, you hear a lot of discussion around loan growth, portfolio growth. As we enter a more challenging loan growth environment, would you mind speaking to how we should be thinking about the large money center banks versus the regionals and who might be more challenged in that type of environment?
It's a really good question because as we've seen, loan growth on a year-over-year basis is still high single digits for the banks. But sequentially, since the beginning of the first quarter, it has certainly slowed down much more dramatically. And this is not uncommon during this part of the cycle. The loan growth in the U.S. banking industry typically grows at the nominal rate of GDP. So if we see nominal GDP growth this year of 4 or 5%, then we should expect 3 to 4% total loan growth this year. But in terms of money centers versus regionals, the money centers are driven much more by consumer lending than the regional banks. The regional banks are driven more by commercial and industrial and commercial real estate lending. And what we saw in the most recent senior loan officer survey on lending, the demand for loans from commercial and commercial real estate customers have really fallen off. So it's a long way of saying the money centers could be the better play on the loan growth aspect of owning a bank right now.